Hello, good evening, everyone. Hello, good evening. Today I'm going to give a presentation about my mini case. This is Farhan Nadi Muhammad, and my professor is Daniel Williams. Now, coming upon to the background introduction, what it's going to be in our presentation. In this presentation, we'll adjust a financial accounting error of a company and demonstrate how transactions are recorded in general normal situations. So we'll make an analysis of how the financial accountings are going on in a company and what are the errors and how it's been recorded. Now, in this particular presentation, we are going to discuss about Parsi Onios is a manager in a purchasing department. The main responsibility of the manager over here is like he gets into the professional buyers and also is responsible for the company's raw materials. He's also personally responsible for producing financial forecasts. So, but due to some internal errors, company's financial statements are off by $350,000. So in this one, we will also provide some suggestion to Parsis teams to avoid such errors in the futures. So now let's analyze what are the relations between the inventory and the cost of goods, how the things were going on and what are the things which were coming into this, how the profit was going on. We will analyze into the different accounts and we'll know how was the production and what are the cost of the goods. So basically, any transaction in a company is critical as it will affect all other transactions on the financial statements. For every instance in the company's transactions, it is related with all the financial statements over there. When a company purchases raw material, it is recorded as an asset. So an asset is a thing which is being served to the company. So anything which company purchases, it comes into an asset. A debit is made to inventory account and credit to accounts payable or cash account. So now coming upon to the raw materials, when the raw materials are used for manufacture finished goods, the inventory assist is reduced. A credit is made to inventory account and the cost of those raw materials consumed will be expanded as cost of goods. So a debit is made. So COGS, which is cost of goods sold, to match against the credit to inventory. So basically, what we are seeing is that what is the company's purchasing, which is recorded on assets, and what are the credits which are being spent on the cost of goods, so cost of goods sold over here. So we can, as we can look over here, like there's a journal and we got a format for what is the date, account, inventory types, what is the debit and credit. In the same time, we also got for the credit, the date, account, debit and credit. And also we got for the inventory and accounts payable. So inventory is like what we purchase and accounts payable is what we pay for the account. Now coming about to the next slide, we're looking on adjusting entries for inventory shortage. It is often been observed that when there is payments in the company, it also comes with the shortage for the inventory. So how the things happens with the inventory will analyze over here. According to financial statements, physical inventory count is off by $350,000, indicating equal worth of polyurethane is missing. So when this purchase has been happened, there was a missing for inventory in our polyurethane. And also we can look at the bottom, like how is the format for that one. You go for the date, account, inventory, write-off expenses, inventory to write-off missing inventory, like which has been missing. That's a debit and that's a credit. And below are the T accounts where you can see cost of goods sold, which inventory are, and in which inventory write-off expenses. As an estimated 11.2 lbs more per refrigerator was being actually used. So this quantity of 11.2 lbs was used in excess. Therefore, an adjusting entry is needed to correct the understatements of COGS. So we had to make an adjustment so that the difference of the COGS and inventory needs to be corrected. That can be done by making into the inventory for going into the debit of COGS And also we need to write for the inventory rate of expenses. By this way, we can manage the minimum difference for adjusting the shortage of inventory. Now, coming upon to the next one, what are the suggestions we can do so that we can minimize the errors or we can minimize the off which is going on the company? So the first thing is that Parsec can use forecast software to get an accurate forecast and inform his team and engineering team about the raw materials needed for the manufacturing. So whenever the raw material is needed for the company, there should be a data, there should be some predictions, and there should also be some teams of the engineering which can analyze how the products are being used and how much is the requirement for the products. Physical inventory counts frequency should be increased and cross-verify that with the for software forecast results. Cross-team communication should be improved to make sure everybody always had the right information. This is very critical while the company is running off. There should be the cross-team communication in all the teams to achieve the good results. Inventory should always be tracked and cross-verified to the amount going out with the number of refrigerators manufactured. Inventory should also be set up with the software where it can be tracked and verified how much amount is going on and how much amount is coming to the account. If these things are minimized and analyzed, the errors can be reduced and the profits of the company can be increased in a very good extent. So these were some of the suggestions for this company. Hope you like the presentations. Thank you. Have a good day.